Good evening, Ken Long from Tortoise Capital Management. It's August 19th, 2009 with a quick review of the daily summary report. We're still in bull quiet, in the middle of the road on annual and 10-day trading ranges. You can see we're back here in the middle on the graphic. Our gap stat is now showing basically 56% of the time the market is reversing its morning gap. We'll pay attention to the 10-day max pain candidates, especially tomorrow. Alcoa and Caterpillar, especially, are old reliables. And if they try to play catch up with the market tomorrow, could be a good day for them. No signals in the overreaction or channeling. They got one more day each of gains should trigger the exit signals. Still bullish on all counts on our indicators. Volatility is at 8 on the index score, so we're still bull quiet. You can see the 30-day regression line has crossed over its 10-day moving average, reflecting the weakness of the last 3 days. Volatility hooking up slightly, but we're still quiet. ADX has leveled off at about 33, and plus DI got marginally better today than yesterday. The stealth candidates all dominated today. Home Depot, Merck especially, and extraordinary days on the triple screens in Kraft and Campbell's Soup, which we'll see later. I've been fiddling with a new report that takes the Dow 30 symbols and then represents their Williams percent, or actually their 10-day index on a scale of 0 to 100, where they are in their 10-day trading range on an index, and are rated with the bar chart. I'm fiddling around with the visual display. I also show this numerically, trying to see which one works better for my reading and for those of the subscribers. The visual display using numbers looks like this. I've created a new report called the Dow 30 and ETF Tactical Report, and it has everything that I really like to see immediately to get a sense out of my favorite trading targets. These are the Dow 30. These are 30 of the usual suspects in the ETFs. You can see the U.S. indexes like NASDAQ, Dow, Russell mid caps and small caps, and the S&P 500. Then the next set are the S&P sector spiders. See, I have the international indexes from the world market model in here, the real estate and treasuries miscellaneous, and I have some commodity plays in here: gold, silver, agriculture, mixed commodities, oil, coal, natural gas, and then the overall broad market. So what I'm interested in is, first of all, in the ticker column, if it's red, then it was exceptionally losing today. It was a laggard. And if it was the green highlight, it was an exceptional winner on a percentage basis, based off of this column here. The 10-day index represents the 10-day trading range on a scale of 0 to 100 and where they are. I highlight 10 and below and 90 and above, so these were the exceptional ones, Boeing and Pfizer. I do the same thing on the 52-week index, but everything, as you can see, is right in the middle. 10-day max pain, if it's highlighted red, that means it was more than one standard deviation below the average in terms of losses, so it was exceptional pain. Green are cases where it was exceptional less pain, in other words. It doesn't surprise me to see Kraft and Merck and Pfizer all exceptionally unpainful. So the same categories over here across the top for the ETF liquid stocks, or liquid ETFs, excuse me. I'm going to keep these in that same order because it has the logical groups and I can read it pretty quickly looking for the colors. I intend to, on this report, sort the Dow 30 as a function of the 10-day index because I want to see where they are from farthest away from true value to farthest above true value based on the 10-day index. So those are two reports that I'm playing with to try to see if how it supports the way I think. And we'll see what the clients think. So thanks for your attention.